Hello everyone, welcome to another video. Today we are going to talk about accounting for bonds if interest on bonds paid more than annually. Sometime company might issue the bonds which might carry semi-annual interest. I mean to say company will pay the interest after every 6 months. Okay. So here you should note the interest rates on the bonds are provided on annual basis. Like usually whatever interest rates are quoted on the bonds, okay, are in the bonds market. So these are on annual basis. So because we are going to pay interest every 6 months, so we need to first adjust the annual interest to the 6 month interest. So this is the formula which we can use. We will take interest rate on an annual basis, okay, and we will divide by number of times interest is paid per year, because this is really important here. If interest is paid after every 6 months, so it means 2 times you are going to pay interest in a year. So how we can adjust, let me just show you small example. So for example, here we have a maturity period of 2 years, and we have stated rate per annum which is 8%. Stated rate mean to say it is mentioned on the bonds. Then you have a market rate per annum which is 6%. Market rate means say it is the interest rate which is prevailing in the market at the time of issuance of bond. So interest is paid every 6 months. So what you will do here, first we need to adjust these two rates. So what you will do, you will take stated rate. How we can adjust, we will take stated rate at annual basis divided by number of times the interest paid per year. So there are 2 times. Okay, so you will get 4% stated rate for 6 months. Okay, then same way you will adjust the market rate also, because market rate on annual basis is 6% divided by number of times interest paid per year, which is 2 times. So you will get adjusted market rate, which is 3%. So same here, you also need to adjust the maturity period. Okay. So maturity period is 2 years. 2 years it is given in the example because I'm assuming the bonds is gonna to be repaid after 2 years. So you will multiply with the times, 2 times, 2 times means say interest paid, interest number of time interest is paid per year, which is 2 times. So you will get 4 periods. Okay, it means overall you are gonna to mature the bonds after 4 periods. Okay, so now here you should remember, if you want to calculate the interest expense for 6 months, this is how we will calculate. We need a face value multiplied by adjusted stated rate. Okay, and adjusted stated rate in my example is 4%. Okay, if you will take face value times adjusted stated rate, this will give you interest dollars. Okay, so here now the question is, when you want to issue the bonds initially at the date of issuance, first we need to decide should we issue the bonds at par or at premium or at discount. So idea is very simple. So what you will do, you will compare stated rate with the market rate. You can look at here, it's a stated rate and it is a market rate. If your stated rate is equal to the market rate, so bonds should be issued at face value. If your stated rate is greater than market rate, so bond should be issued at premium. If your stated rate is less than market rate, so bond should be issued at discount. Okay, but the question is, how can we calculate the amount of premium or discount? So simply what you will do, you will take a present value of uh, future cash flows associated with the bonds. Okay, and we will discount them back to the present values. Okay, so future cash flows are face value of the bonds which will be redeemed by the company at maturity date, plus company will pay interest after every 6 months. So we are going to calculate the present value of these two cash flows. So face value of the bonds we will always multiply with the present value factor at market rate. Okay, and here you should remember here, present value factor, you will look at market rates, and here market rate you should take adjusted market rate, which is 3%, not a 6%. Okay, so you will go to the present value table, look for 3% in the column of 3%. Okay, and look for 4 years, you will find this factor there. Okay, so same here, I will show you by the way from where you can find once we will do the question. Same here, what you will do, you have here interest amount, okay, which is for 6 months, okay, multiply by annuity factor at market rate. Again, you will go to the annuity table, look at market rate, and market rate is here, adjusted market rate is 3%. Okay, so you will look for 4 periods because periods are four, huh? Not two. Okay, so here then once you will make the summation of these two present value, so this is what is called total present values. It is also called issue price, market value, or cash proceed. So this total present value you will compare with the total face value, which will be given. Of course, the difference will be either the amount of premium or discount. So how we can decide it is a premium or discount? So what you will do here, here we have a three scenario. If your total present values are greater than total face value, so it is called premium. Okay, and how we will record the entry at the time of issuance? If there is a premium, we will make debit cash with the total present value. Credit will go to bonds payable with the face value always. Okay, and the credit will go to the premium on bonds with the difference. Okay, second scenario, if your total present values are less than total face value, this is called discount. So in case of discount, what you will make, do the entry, you will make debit cash with the total present value, debit discount, debit discount on bonds payable with the difference of present value and face value, and credit will go to the bonds payable with the face value. Third scenario, maybe if your total present values uh, are equal to the face value, so it means bonds should be issued at par. So at that time, we will make entry debit cash, okay, credit bonds, because here your present values will be equal to face value, so you can directly write present value or face value, doesn't matter. Okay, so here we go, let's have a look, quick example. So then we will talk about how we will measure subsequent in the balance sheet date. So here we have a small example. They're telling you on January 1, year 1, EVA company issued 5 years. 5 years is the maturity period, by the way. 6% is the stated rate of interest. 100,000 bonds, it's a face value. The bonds pay interest semi-annual. Okay. So here what we need to do here, first we need to adjust. And by the way, we have here, they're telling you the bonds were issued to yield 10%. Actually, it is a market rate. Okay, and the market rate on the day of issuance was 10%. It's also same because interest is paid twice a year. So first of all, we need to adjust the interest rates. Okay, if you look at here, your stated rate is 6%. Okay, we have here stated rate 6%. So what I will do, we will take this 6% divided by, because number of times interest is paid is 2 times. So if you will divide it, you will get adjusted stated rate, which will be 3%. Okay. Same here, you will also need to adjust the market rate. Okay. And how we can adjust market rate is 10%. So you will divide it by number of times interest is paid, which is 2 times. Okay, so this is how you will get it is 5%. Okay, and don't forget, when you want to calculate the interest, for example, if I want to calculate the amount of interest, what I will do, I need a face value which is $100,000. Okay, and I will multiply with the stated rate, huh? Don't forget here, stated rate is adjusted stated rate is 3%. So this is how I will get the interest per 6 month. Okay, this is $3,000. Okay, when you want to calculate the present value, okay, we will always use market rate. Okay, to look at the present value factor, we will use the market rate. Don't forget. So here we go. Now we are going to calculate the present value of face value. We have here, you can look at here, bonds face amount was 100,000, and we will multiply with the present value factor, And present value factor, you can look in the present value of $1 table, look at 5% because 5% is our market rate for 10 periods. Why 10 periods? Because maturity years is 5 years, so and interest is paid twice a year. So 5 years times 2, you will get 10 periods. So you can look from here. You can see here the present value factor is 0.614. Let me show you from the table. So you will go to the present value of $1 table. Look at 5% because adjusted market rate is 5%, and look for 10 periods. So 10 periods are here. So here is the 10. You can look at here at 5%. It is 0.614. Okay, so this value you will multiply here. Okay, 0.614. So you will get this value like 100,000, which is the phase, times this is the present value factor, you will get 61,400. Same way, you also need to calculate the present value of interest. Interest is 3,000, okay, for each 6 months, multiply by the present value of ordinary annuity of $1 at 5%. Now, ordinary annuity mean to say you will go to the annuity table. Okay, so here we have annuity table. This is called annuity table, ordinary annuity. Look at 5%. Here is the 5% column and look for 10 periods. So value should be 7.722. Okay. So this value 7.722, you will multiply with the amount of interest. You will get another present value. Now what you need to do, just we will make the summation of these two present values. This will give you total cash proceed, which is 84,566. And now this value you should compare with the face, and the face value is $100,000. And you can look at here, whenever your present values are lesser than face value, it is a case of discount, and the difference will be the discount difference in face and difference in present value. So here we have entry. What entry you will pass? You will make a debit cash with 84,566 because cash will be debited with the present values. Debit will go to the discount on bonds payable, which is the difference of present values and face value, and the difference is 15,434. And credit will go to bonds payable with the face value. This is what how initially you will record your bonds. Okay, now what to do for the subsequent measurement. So this video will be a little bit longer because this I'm trying to cover here. So bonds payable subsequent measurement. So you should remember here, this is always the formula to record or to calculate the carrying amount of the bonds, okay, in balance sheet. How we can calculate? In the balance sheet, this is how we can present our bonds. We will write total face value of bonds, okay, add unamortized premium. Unamortized premium mean to say the total amount of premium minus accumulated amortization, and I will show you. Okay, so this is how you will get unamortized premium less unamortized discount. Unamortized mean to say the discount. Unamortized discount mean to say the discount which has not yet amortized. Okay, so how you can calculate? You will take discount value, total discount minus accumulated amortization. The same here, you might have a unamortized debt issue cost. So debt issue cost means that sometimes companies might incur certain cost to issue that debt. So what you will do, you will take total issue cost minus accumulated amortization of issue cost. So this is how you will get unamortized debt issue cost. If I will take these value, face value plus unamortized premium less unamortized discount less unamortized debt issue cost, this is how I will get carrying value in balance sheet. Okay, so same here, because I will amortize here on the semi-annual basis, I will amortize premium and discount here. Okay, so then we have here income statement presentation, how you will present the income statement. So usually what we will take in income statement, you will always you record your interest expense at effective rate, and how you will calculate, I will show you, just wait. But it can be calculated this way also. We need interest paid at stated rate. Let's say it's the actual interest payments which will be paid as per stated rate less amortization of premium. So this the for the period whatever amount is there you will subtract, add amortization of discount. you will add here. If you will add these three value, so this will be equal to interest expense at effective rate in the income statement. So here you can add one more value, by the way. So you can add here amortization of that issue cost as well. Okay, amortization of that issue cost. Okay, so let's have a look. So let's have a look here how we will amortize premium or discount in case of semi-annual interest. So we always use effective interest methods, okay, to amortize the premium or discount values. Even we can use effective interest method to amortize the debt issue cost. And under effective interest method, what we will do here, if you want to calculate the interest expense, you always need a carrying amount multiplied by effective interest rate. Effective, market rate, don't forget. So this is how you will calculate interest expense, and I will show you through the proper format also. So if you want to calculate the cash interest paid mean to say it is the amount of interest which you will pay as per stated rate, and actually it is the actual cash payments. Okay, so how you will take face value multiplied by stated rate. So here we go, because to solve every point, we need to prepare amortization schedule first. Okay, and then we can solve every question. So here we go, how we can prepare amortization schedule by using effective interest method. Here we go. So here, because we have a case of amortization of discount, so effective interest method I'm going to talk about. When you will amortize the discount, like what is the amortization of discount mean to say, because discount you have shown in your balance sheet, okay, as a reduction in the face value. So now this discount over the bonds term, you will take it to the profit and loss account. So that is why it is called amortization. How can we do it? So here we have a proper schedule, and this you can prepare. It's very easy, not hard. Please focus. So first we have here periods. I'm not using word years, because in my example, what we did now, life maturity period was 5 years and interest is paid twice a year. So that is what total period will become 10 periods. Okay, over the 10 periods, you are gonna to pay the interest. Okay, or after 10 periods, your bond is gonna to be matured. So what you will do first, you will write here period 1, 2, 3 till 10. Second column is for beginning carrying amount. Then you will multiply beginning carrying amount with the effective rate, which is 5%. I will put it here, 5, not a stated, it's effective. Then it will give you equal interest expense. So from this interest expense, you will record in the income statement. We will see how it is calculated. Okay, from this interest expense, if I will minus cash paid, because actually I'm paying interest based on stated rate, which is for every 6 months, 3,000, 3,000. I will put all this value here. Huh? Then you will get equal. This will be equal to discount amortized. Like if you will take the difference of these two columns, like interest expense and cash payments, you will get discount amortized. Then you can calculate the ending carrying amount. Ending carrying amount, how you will take beginning plus amortization of discount. Okay, so if it is the case of premium, so here you will take beginning carrying value plus a minus amortization of premium. Okay, that I will show you at the end. Just let's amortize first discount. So here we have a year one. So in year one, which period one I mean to say, in period one, we will start beginning carrying value with the present value. So here you will put always present value, don't forget. Always present value. This is always present values. You will multiply with the factor rate, which is 5%. If you will multiply these two values, you will get interest expense, okay, of 4228.3. Actual cash paid is 3,000, okay, because as per stated rate, if you remember, I told you above, we will pay 3,000 as interest. Let me show you here. Okay, we have paid 3,000 as interest. Okay, here we have calculated 3,000 of interest. Okay, so now so what you will do, if you will take the difference of interest expense and cash payments, it will be equal to amortization of discount. And if you want to calculate the ending carrying value, what you will do, you will take beginning carrying value plus amortization of discount This is equal to ending carrying value. Then this, please note here, this carrying value you will get at the end of first 6 month. Okay, like I'm assuming July 1 year 1. Okay, so this carrying value will be the beginning for next period. Okay, again I will multiply with the 5%, so I will get interest expense. Okay, but actually interest paid is 3000. Difference of interest expense and cash payments is equal to discount amortized. If I will take beginning carrying value plus amount discount amortized, okay, you will get ending carrying value. This ending carrying value you have at the end of the first year. Okay, I mean to say after second 6 months. Okay, so then this carrying value will become the beginning value for next, again 5%. You will follow the same process over the 10 periods, and once you will do for all the 10 periods, you will get here value equal to 100,000. But my value is $115. $15 is the difference of rounding. Okay, it's a rounding difference. Okay, uh, now here what you need to do here, because once this amortization schedule is ready, okay, once it is ready, so what you need to do, so now we can present in the balance sheet or in the income statement by following the format here. So here we go. So first we need to understand the entries to record the amortization of discount. So what is the entry? Please note. So in July 1 year 1, I mean to say in the first 6 month, after first 6 month, you will make debit interest expense by using interest expense column. Let me show you. It is interest expense. This is interest expense. Debit interest expense. Okay. Debit. Then we have here entry credit the amortization credit. So you will make a debit interest expense. Credit will go to discount of bonds payable, because discount was debit. Now you will make it credit. And discount amortization value you will check from the discount amortization schedule, and here we have this value. This is the discount amortization in the first quarter, I mean in the first 6 months. This is the amount of amortization. And the credit you will make the cash. Okay, because cash you paid 3000. I mean to say, don't forget the entry is debit interest expense with the interest expense value. Credit is the discount on bonds payable with the amortization amount, and credit is the cash. In short, we will use these three columns to pass the entry. Okay, this is for interest expense. This column for interest expense. This is for cash payments, and this is for amortization of discount. So same way in the second 6 month, I mean to say at 31st December year 1, again I will take debit interest expense with this value. Okay, uh, debit sorry credit discount on bonds payable with this value, and credit will go to cash. Okay, so same entry you will pass, you will use the same column. Okay, debit interest expense, credit discount on bonds payable, and credit cash. Okay, even in the next, throughout the over the 10 periods, you will pass the same entry but use the value from the relevant years. Okay, now here the question is that how we can present the bonds in the balance sheet at the end of year 1. Okay, at the end of year 1, so what you will do, you will take total face value of bond, which is 100,000. Add unamortized premium, because it's not a premium, it's a discount. So we have here subtract unamortized discount, which how you will get, you need a discount value minus accumulated amortization. Okay, because we are sitting at the end of year 1, not the end of the period 1. Okay, at the end of year 1. So here we have a total amount of a discount which you have recorded when you issue the bond of 15,434, minus, now you will subtract here accumulated amortization. Okay, accumulated amortization, because in first year you have calculated 2 times amortization. So 2 times amortization values are this, you can check from the schedule. Okay, so here we have here first value is this value, and for the amortization second value is the this value for the amortization. Just make the summation of these two. This will give you, this will give you total amount of accumulated amortization in year 1. Okay, so what we will do here, simply we have here total value of discount minus accumulated amortization of 2 periods. So you will get unamortization of discount. If I will take face value, less unamortization value of discount. I'm assuming there is no premium, there is no debt issue cost, so you will get carrying value. So same here, if you want to present in the income statement in year one, what you will do, you will take interest paid at stated rate. By the way, because in first year you have paid interest two times, so 3,000 in the first 6 months and 3,000 in the next 6 months. So it means total interest paid is 6,000. Okay, less amortization of premium because there is no premium. Add amortization of discount because in first year you have amortized the discount two times. Okay, so here this is the value of two times amortization in the first year. If I will take 6,000 plus this, it will become equal to the interest expense at effective rate. Okay, so let me show you what interest expense at effective rate mean to say. 8,518 dollar in the first year is the interest expense. Look at here, if you will, this is the interest expense column. If you will make the summation of these two, it will be 8,518 dollar point zero five. Okay, it's the same. Okay, now you can match also because we have calculated the carrying value at the end of first year. We have calculated of 87,000. Okay, 84.02 dollar. So you can look at here, it is the same value at the end of the first year here also. Okay, because this is the end of the first year. So this calculation you will repeat over the periods are over the number of years. Okay, if you are doing calculation annually, so you will do this calculation 5 times. If you are doing half yearly, you can present the balance sheet and income statement 10 times. Okay, so I hope it is clear now what to do if there is a case of discount, if the case of premium. Okay, so what we will do here in premium, first of all, the difference I'm going to tell you, your present value which you will write in the first period will be greater than face. Okay, again you will multiply with the 5%, you will get interest expense. Okay, you will get interest expense minus actual cash payments, because cash payments will be more under case of premium. Okay, so the difference more than what, more than interest expense. Okay, so what then you will take the difference here, you will get amortization of premium, amortization of premium. Okay, and this you will take beginning carrying value minus amortization of premium, so it will be equal to ending carrying value. Again ending will become for the next. So what is the main difference? Difference is quite simple. Difference is that first difference is in the case of premium, your present values are greater than face. Second difference is what, your cash payments will be greater than interest expense, but the difference of interest expense and cash payments will be amortization of premium. And third difference is what, you will take beginning carrying value minus amortization of premium will be equal to ending carrying value. Okay, this is how you will do. Now the question is that what entry you will pass if you have amortization of premium. Here we have a entry is this, you will make debit interest expense with the interest expense column. Debit will go to the premium on bonds payable, because premium usually it's credited at the time of issuance. So once you want to amortize, you will make it debit. Okay, and credit will go to the cash. So this is how you will amortize the premium. By the way, if you want to learn proper how with the help of calculation, so I will provide you the link in the description for other video, because there I have already amortized the premium. Okay, but the difference, only the difference is there. Okay, I'm amortizing on annual basis. Here you have to amortize over after every 6 months. I hope it is clear. If you will have any question, you can ask me through the comment section. So see you in the next video. Thank you so much. Bye bye.